Hello everyone, a very good morning to everyone. So in today's class, let's see module C marathon. Sharing first question, that which of the following most accurately reflects the transformation of the treasury function in the Indian banks post liberalization? See, just read the question and then give the answer. Most accurately refers the transformation of the treasury function in the Indian banks post liberalization. If we check the things historically, basically, like the treasury function in Indian banks was limited to only liquidity management, which ensures day-to-day operational funding, fulfilling the CLR and SLR mandates, as well as serving as a compliance focused support function. So we can say this treasury evolved into strategic profit center, which uh, which basically engaged in proprietary trading, market based investing, risk based, particularly through ALM and derivative products. It also acts as an advisory unit which guides the senior management on guiding security strategies and global fund allocation. So, option C, we can say, captures the holistic evaluation of treasury from a compliance back office to a dynamic multidimensional market facing the unit. So, from a liquidity and compliance center to multidimensional unit involve profit generation, market interface, and also risk management. So, option C is correct. So, in the context of integrated treasury, how does the shift from segmented currency management to unified cash flow impact risk management strategy in the banks? See, if we talk about the correct answer, this integrated treasury unifies the domestic and the foreign currency and both cash flows in a single cash flow management, which eliminating the traditional separation between rupee and foreign currency operations. This approach is essential because cash is always the cash, regardless of its currency, but the risk associated with each component differs substantially. So, integration also amplifies the need of the derivative instruments. So, we can say that It necessitates a consolidated approach to market risk management, which is accounting for the interest rate, price, currency risk, and offer through the derivatives. So we can say that option C is correct. Next question. Which of the following is not a direct implication of trade capital account liberalization in the context of treasury operations in the Indian banks? See, here, while the liberalized trade, like current account transaction, this is an outcome of the broader economic returns. Capital account liberalization specially refers to the freedom to move the financial capital across the borders, such as foreign direct investment, external commercial borrowings, overseas investments by the Indian companies, and treasury operations have evolved in response to this by engaging them in the interest arbitrage, interacting the rupee and foreign currency operations, using the market derivatives to hedge risk arising from volatile capital flows. So, we can say the correct answer is liberalized trade of goods and services. So, how has the process of globalization transformed the functional domain of bank treasuries in the India? So, if we check about the correct answer, here this globalization obviously makes necessity uh, that there is a shift in the treasury. Multi This treasury manages the multi-currency cash, merging rupee and foreign currency books. It also engages in the cross-border capital deployment. It acts as a key player in risk management, also assist in the asset liability management. It also supports the merchant services for the large corporates, which includes hedging, foreign borrowing, and advisory roles. So, if we see the correct answer, this is the correct answer. It has integrated treasury operations with broader balance sheet management and cross border financial safety. So, option B is correct. Which of the following best describes interest arbitrage by the bank's treasury? See, interest arbitrage involve capitalizing on the difference in the interest rate between two countries or financial markets. A bank here borrow low interest rate foreign market and invest the proceeds in a high interest rate domestic market. And if we talk about the speculative activities, arbitrage is risk controlled and it is based on known spread, but it is not restricted for hedging. So it is not about investing deposits as well as investment in the risky instruments. So the correct answer is exploiting the interest rate differential between domestic and foreign markets. Next question. What role does the concept of open opposition play in the treasury forex trading? Read the option. See, here if I say about the correct answer, open position means when a forex trade is not squared, like buying and selling, these are not balanced, which exposes the bank to exchange rate risk since the currency value can fluctuate. This open position is not a profit guarantee and also does not represent the central bank reserves. So we can say it reflects the unrealized profit loss due to unsquared forex trade. So option D is correct. So which one of the following reflects the transformation of treasury into a profit center? See, we know that this modern treasury has evolved serving the internal cash needs or focuses on the regulatory compliance. Here, by engaging in the proprietary trading, taking positions in the securities and derivatives for its own account, treasury acts as a profit center. So that's why we can say other options are incorrect and treasury basically acting as a proprietary trading in the securities and the derivatives. So the correct option is option C. Now which one of the following correctly explains the purpose of segregation between front office, back office, mid office in a bank treasury? See, segregation, segregation of unit is not just about the spread or efficiency, but about the risk containment and the internal control. And we know that the front office is basically is like profit driven and may take risk to earn more. Back office independence and verifies the trades as well as handles the settlement, ensuring that trades are valid. This mid office act like a watchdog which measuring the risk exposures, stop loss the limits and reporting directly to the top management or the risk department. So anyone to perform multiple roles that thing violate core internal principles. This is especially for the market sensitive operations. So we can say the correct answer is to maintain the interdependence and ensure proper control risk is the purpose of segregation. So in the organization of an integrated treasury, which of the primary function is of the mid office? See, mid office is all about monitoring and analysis and monitor the treasury risk limits. This mid office is all about like monitoring and analysis and approvals. It works on real time, like market risk exposures, stop loss limits, transfer pricing, adherence to ELCO guidelines, compliance with the RBI regulatory limits. It also generates the MIS reports, so the senior management and the ELCO informed. Unlike the front office and the back office, the mid office does not touch the deal directly. It ensures the deal was within the limits and aligns with the bank's risk appetite. So bank have to maintain functional independence of the mid office, which reports to the risk department rather than the treasury to keep the risk assessment unbiased and accurate. So the correct answer is here, providing the management information system and monitor the treasury risk limits. See, there is a highly liquid and efficient foreign exchange market. So why is the forward exchange rate considered a forecast to the future spot rate? See, see, in the efficient market, we know that forward exchange rate is equals to spot rate plus or minus whatever the interest rate differentials between the two currencies. So forward rate always reflect interest rate differentials, not the market expectations. This is the correct one here. Which of the following best describes the function and significance of the NDF market? See, this NDF are synthetic forward contract. They do not involve actual currency movement. When the contract matures, the two parties settles the difference in US dollar and another convertible currency. So some currency like the INR or other non-convertible or partial convertible currencies, that means foreign investors can freely buy, sell these currencies in their local market due to the capital control or regulatory restrictions. NDF markets here, basically foreign investors hedge the exposure, speculators bet on the future movement, and when there is no physical delivery, NDF bypass local regulations, making them a double-edged tool, which is useful for the risk management but also capable of pressuring a country's currency by external speculation. So the correct answer is option C. Which of the following statement best explains why future contract eliminate counterparty risk if we compare to the forward contract? See, we know that unlike the forward contracts are private and bilateral. Future contracts are exchange traded. This means clearing house of the exchange becomes the central counterparty for every buyer and seller. It legally guarantees the settlement if no one party defaults. This system uses initial margins and daily market making marking to market just to manage the risk. Losses are adjusted every day, which keeps the positions transparent and reduces potential losses piling up. So no party depends solely on the other, and the exchange bears the settlement responsibility, also eliminates the counterparty risk. So the correct option is future contracts are guaranteed by exchanges that act as a central counterparties. Now, how can currency swap between the INR and US dollar create a profitable interest arbitrage for a treasury, and under what market conditions is such arbitrage sustainable? Uh, yes, Ashok sir. If you clear your JAIIB and SEB examination, like you are staying in that one bank, but if you shift to any other bank, so still your JAIIB and SEB exams are valid. Okay. So if you this basically, once you clear that exams, this certification remains valid for lifetime. So yes, that is okay. Your JAIIB exam will be there with you. Now, see, interest arbitrage that via currency swaps becomes possible in the market with currency convertibility restrictions such as INR market. So in these cases, the forward premium or discount may not perfectly reflect the interest rate differential between INR and US dollar. So here we can say the correct answer is when the forward premium on US dollar is lower than the interest rate on INR in a regulated currency regime. So option B is correct. So in the context of foreign exchange surplus management by banks, what is the primary rationale behind deploying idle balances from nostro account using a sweep facility? See, these nostro accounts are the current accounts held by those banks in the foreign currencies with the correspondent banks abroad. These accounts generally do not earn any type of interest. To prevent the idle balances for staying unproductive, some foreign banks offers this sweep facility. They automatically transfer excess balances into the overnight money market instruments and credit interest back to the bank. So, to optimize the short term returns on idle foreign currency without violating liquidity requirements is the correct answer here. So, why does the call money rate serve as a highly sensitive and reliable benchmark for short term interest rate instruments in the India? See, this call money rate represents the interest rate at which banks borrow from and lend to each other overnight. It is the purest reflection of liquidity in the system on any given day. So, if we talk about the correct answer, it adjusts daily based on real time supply and demand of liquidity in the interbank market. Do the next question, read the options. See, why does the government of India issue treasury bills at discount rather than offering traditional coupon interest payment, especially for 91 day, 182-day maturities? See, these treasury bills are zero coupon instruments, meaning they don't pay any periodic interest. They are sold at discount and redeemed at the face value. This structure helps the government managing the short-term borrowings efficiently, avoid the administrative and accounting burden of paying the coupons. It precise control the cost of borrowing by settling the issue yield via action. It creates instruments that are highly liquid, simply to trade and easily benchmark. So the correct answer is here because discounted instruments allows precise control of yield, liquidity and the cost in the short term borrowings. Next question. See, one of the key reason is that these treasury bills are popular among the bank is the active secondary market, which ensures liquidity, like banks can buy, sell them anytime before the maturity. There is a transparent price discovery, like regular updates on the T-bill yields, which is published by the FBIL, and efficient settlement is there that is done via CCIL, which ensures smooth, fast, and secure transactions. So, we can say by facilitating the continuous liquidity, price discovery, and low cost settlement of short term investment, that is the correct answer. Which of the following best explains why cash management bills are excluded from the non competitive bidding scheme, unlike the treasury bills? See, these cash management bills, as per the government temporary cash need, which can arise without any prior notice. The tenure, amount, timing, these are not fixed in advance like T-bills. So here we can say the unpredictability and urgency of their issuance make them unsuitable for prefixed retail allocations. So option B is correct. From a risk return and regulatory perspective, why might a bank treasury prefer to invest in highly rated commercial paper over extending working capital loans to the same corporate borrower? See, these CPs provide the market driven returns but often higher than the interbank market rates. They are short term, low and lower credit risk is there. Bank can sell before the maturity. These commercial paper also meet the liquidity needs, which making them a flexible treasury tool. So CP offers short-term tradable exposure with the capital market pricing, while these loans tie up capital under the stricter provisioning norms. So option C is correct. Which of the most following plausible reason for limited secondary market activity in the certificate of deposits despite being traded and eligible for the institutional investments? See, we know that the CDs are tradable and they have high stamp duty, they have the limited liquidity and low yield differentials versus normal deposit, which make them less attractive to trade, especially when banks do not face any liquidity crunches. This secondary market interest picks up only during tight liquidity condition. So these CDs often serve as passive liquidity reserves rather than active tradable assets due to their unattractive cost benefit rate, which are off in the normal liquidity conditions. So the option is C correct here. Next question. Where in a market repo transaction involving corporate bonds, which of the following combination captures the regulatory and risk implications for the lending bank? See, we know that corporate bond repos do not enjoy the SLR and CRR exemption like government bond repos. Lender is exposed to the credit risk and market risk, but haircut helps but does not eliminate the risk. So the borrower liability is netted against banking system liabilities and the lender is exposed to both issuer credit risk, market risk due to non-sovereign nature of the security. Which of the following best describe the impact of daily mark to market in the trap system which is operated by the CCIL? Mark to market helps in managing the price risk. If collateral value drops, margin calls ensures the safety. So it ensures that what value of collateral always exceeds or match market volatility with margin calls triggered for price drops. So the option B is correct here. Under the revised LAF framework by the RBI, which of the following is not correct? See, RBI can conduct variable repos and reverse repo for 1 to 13 days as well, not just 14 days. So, RBI does not conduct variable operations for shorter than 14 days. So, under the standing deposit facility, which of the following statement best explains why placed are not eligible for the CRR calculation but qualify as the SLR assets? Because the CRR requires balances to be maintained with RBI in the cash form without interest and collateral. Since SDF is a interest bearing facility without the collateral, it cannot be treated as a part of CRR. It quantifies for SLR because it acts as a liquid asset for banks. So SDF lacks collateral, which disqualifies it from CRR but retains liquidity characteristic qualifying for the SLR. Next question. See, why MSF is used? Just by the banks to borrow the overnight funds. Typically, when the interbank borrowing fails, so SDF is used to park the excess funds and earns the interest. So here we can say MSF penalizes overnight borrowing, SDF rewards excess liquidity storage. There is a government security with 10-year maturity and 6.25% coupon is trading at rupees 104 in the market. So which of the following statement is correct? See, if the bond trades above rupees 100, it means market demand is high and prevailing interest rate which are lower than the bond's coupon. Hence the price rises. So YTM in such cases is less than the coupon rate. This is the classic bond market behavior where the price rise when rate decrease. So the correct answer is the bond is priced above the face value, which indicate the market interest rate have fallen. Which of the following statement best explains the rationale for higher yield on corporate debt instrument compared to the government securities? See, here we can say corporate debt lacks the sovereign backing. So investors demand the higher returns to compensate for the credit risk. Government securities are considered risk-free, whereas bonds may default. So the correct answer is corporate debt carries inherent credit risk that must be compensated by the higher returns. So in the context of the convertible bond, which of the following outcome is most likely when the market price of the issuing company share exceeds the predetermined conversion price. See, market price is greater than the conversion price, and that converting the shares into profitable for the bondholder. This eliminates debt for the issuer but dilutes the existing equity. So the bondholder will opt to convert the bond into the equity shares. So correct answer is option C. Which structural feature of a bond primarily reduces the issuer long-term cost of borrowing while maintaining the investor's appeal? C. Zero coupon bonds does not pay any periodic interest. They are reducing cash outflows during the bond life, which issuing at a discount offers investors return while managing cost for the issuer. So the correct answer is option D. Which regulatory clause limits a bank's direct capital market exposure in the equities? Section 19, subsection 2 of Banking Regulation Act restricts a bank investment in the equity the lower of 30% of bank's own capital plus reserves or 30% of the investee company's capital is the correct answer here. In case of a default or secured corporate bond, which of the following entities is empowered to initiate the legal action and protect the bondholder interest? C. The trustee under the trust deed holds the charge on the assets and represents the bondholder's interest. They are empowered to act legally in the case of default. So option C is correct. Under the extent FEMA framework, which of the following scenarios would not be categorized as FDI? See, this FDI is defined as investment by a person resident outside India, either in an unlisted company or less than or equal to 10% in a listed company. So we can say that the correct answer is option B, where US funds invest 8% in a listed company on a fully diluted basis. Identify which of the activity farm from the following list that is permissible from foreign investment without requiring prior government approval. C. Construction of farmhouses, licensing of a brand name for a private lottery operation, and this retail trading of tobacco products. These are prohibited activities. Option D is here an FPI in a listed company, that is a permitted sector which allowed without any prior approval. So the option D is correct. Which of the following best explains the implication of a non-resident investor in a shareholding falling below 10% in an Indian listed company after an FDI transactions? C. According to the FEMA, if a shareholding falls below 10% after qualifying as a FDI, it continues to be treated as FDI. There is no obligation to reclassify it as FPI unless a fresh investment is made under the FPI route. So the investment continues to be treated as FDI for the regulatory purpose. Which of the following best justifies the rationale for maintaining the debt to equity ratio unaffected upon issuance of GDR by an Indian enterprise? C. Issuing the GDR increases the equity capital. That is not a form of foreign ownership. So while liabilities remain unchanged, equity increases, so debt to equity ratio improves or remains stable. So GDR result in an accretion to equity capital, thereby expanding the denominator of the ratio. Which conditions must be priorly satisfied to the redemption of Indian depository receipt into underlying equity shares by the domestic investors? C. IDRs cannot be redeemed into underlying shares before 1 year has passed since the issue. This lock-in ensures market stability and the regulatory compliance. So a lock-in period of 12 months must elapse from the issue date for redemption eligibility. Under the two-way fungibility scheme applicable to ADR GDR, which regulatory principle ensures that the total outstanding receipts do not exceed the initially approved foreign holding cap? See, here we know that reissuance is allowed only to the extent that earlier GDR and ADR have redeemed and converted back into the equity, and they have to sold in the Indian market. This ensures the original cap is not breached. So permitting the reissuance only to the extent of previously redeemed GDR and ADR is the correct answer. Which of the following transaction would not be permissible under the regulatory framework which governs the rupee denominated bonds? See, we know that these INR denominated bonds cannot be converted into any foreign currency. This restriction protects the Indian foreign exchange reserves and prevents the currency risk on the RDBs. So the correct answer is option B. Conversion of RDBs in from INR to US dollar to hedge the foreign risk exposure. So there is overseas depository holding the shares of Indian company on the behalf of GDR holder, which is legally entitled to which of the following corporate right? We know that depository holds actual equity shares, so if it exercising the voting rights in shareholder meeting on the behalf of GDR holders. GDR holders themselves do not get direct voting rights. So the correct answer is option C, where voting rights equivalent to the underlying equity shares. Let's see the last question for today. The liquidity observation impact of an upward version of CRR is functionally analogous to C. We know that raising the CRR reduces the bank funds, which is similar to the open market conditions, where RBI sells securities to absorb the liquidity. So both reduce the excess money in the market, and this OMO is indirect and CRR is direct. So the correct answer is sterilization through the open market operations. So these are some questions in our module C. Apart from these questions, I will upload some more questions in PDF with the class, so you can go through with the PDF and check all the questions. I will upload with the answers. Any problem you feel, just do the comment below, so I will check and help you out. Thank you for this session. Let's meet in our next session. Till then, take care and have a good day. Thank you.